The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Risk and Methodology. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello, Forex Academy subscribers and members, and welcome to this next video here. We're going over, this is falling into the psychology component of our trading psychology course. It had some, it's the entire market psychology, trading psychology, then the methodology and the risk management. They all kind of roll in together, so it's difficult to separate some areas and it's easier to do with others. And what we're going to be talking about today is behavioral trading methodology, understanding how behavior is involved in the markets. Okay. And so, you know, when we talk about behavioral trading, or even in, you know, broader, bigger, super sophisticated term of study, behavioral finance, it's kind of different than what's known as the efficient market theory, or the efficient market hypothesis, which states that everything's always at a discount. So any new news, information, or event is automatically registered and validated by the market immediately. So, you know, that's one of the kind of old school tenets of market theory, is the efficient market hypothesis, that the market is always at a discount. That may seem hard to believe, and certainly it is. That's why it's just called a hypothesis. It's not a law. It's just a theory. Because when we talk about behavioral finance, we talk about something that is kind of to the opposite of that. We are saying, in behavioral trading, that you know, really not even focusing on whether the market is at a discount or not, but that we as humans have a great amount of influence over the price action and the value. So, you know, it's one of those things that, you know, you'll have believers and people put into certain camps, and, you know, and in the long run, the which is correct doesn't really matter. But we just have to know is how do they relate to trading, and how does one work versus the other. And certainly for traders, behavioral trading is something that we want to identify and be aware of more than anything else, because we're really not concerned about the long-term value or discount of an underlying instrument, because we're trading it. We're going to be going in and out of it really fast. Okay, so one of the things we got to understand is that the markets are made up of individuals. There's a whole bunch of us. This is probably something you're aware of, that the markets are just all made up of individual people and traders. And so the theory is that the price action determines the sentiment. So if I look at a daily chart, what do I infer from this action right here? What do I infer from this downward move? Is this telling me that people are bullish or bearish? Because when bullish or bearish doesn't just mean rising and falling markets, it's really indicative of what are people feeling. Okay, so if prices are moving down, that means more people are feeling apprehensive or weak about an underlying instrument, as opposed to being hopeful and excited. So that's one thing we got to realize, is that the participants' mood is reflected in the price action. The other thing that we want to be aware of is the the way that big players and institutions, how they influence the markets, okay? Because really, especially in Forex, a large amount of the activity is done by two groups: retail traders like ourselves, and then large funds and banks. There's a reason that trillions of dollars worth of currencies are traded and swapped each day in Forex. It's the most liquid market in the world. But a lot of that liquidity comes from you and me. But regular individual traders, we can't move a market by ourselves. Now there are some, there's just, if you don't believe that, that's fine. I mean, I don't believe it either, but for the most part, 99.9999999% of traders cannot move the market by themselves. It just doesn't work like that. But there are entities and organizations that can move markets, okay? And if you think of the markets being manipulated, then you're constantly looking at the market as something that is not true and honest, and you're never going to be successful at trading. Manipulation is, I don't think it's a bad word. I mean, of course markets are manipulated. Everything's manipulated. But the point is that we just have to understand that just because there's an entity or a group or a bank has a lot more money doesn't mean that they're not slaves to the same type of market patterns and movements and cycles as everyone else, because they are. The point that we want to be aware of as traders is that we always want to be a part of the trend. You've heard that phrase, the trend is your friend. That's a very common phrase, but it's true. It's very true. So big money, that's another phrase I hate, but we'll call it that. Big money kind of is going to tell us in the short term what direction it's going, okay? Big money is going to have a huge influence on the macro direction we're going. And the point is that if you think of all the participants as a school of fish, all right, like or birds in the air, we want to be in the school of fish. We want to be a bird flying with the flock in the flying V formation. We don't want to be a single minnow out by himself. We don't want to be one of the birds who has stopped in the cornfield to eat a couple pieces of more pieces of corn while everybody else is flying off in a different direction together. Really, the art and the behavior of trading is to be a part of the move of the market. So when they say don't buck the trend or don't or stick with the trend, or the trend is your friend, all that jazz, that is a very, very honest and true representation of the underlying behavior of trading. Is you want to be in the trend. Now, it's always a question is, well, how do you know if you're in a trend? Because like everything in the market, well, nearly everything in the market, you don't know that you're in a trend until the trend is already there. You have to do some backwards analysis. For instance, if I'm looking at this chart here, this time frame, and I see, okay, maybe about here is when I realized I'm in a downtrend, okay? And then we see it continuing, but then, we start ending up in type of an uptrend. And, when do you know you're in an uptrend? When does that finally happen? How many days, weeks, or months have to go by before you realize that you are already in a trend? That's the difficult part for a lot of traders, is to figure out when and if they are in the change of a trend. Okay, but the point is that we don't want to deviate from the masses. Okay? There's a difference between finding a bottom or a top in a long-term or short-term trend and doing that early. But that's different than trying to counter trend trade an entire long-term trend. That is just stupid. That is dangerous. And so, one of the ways that you can, see if you are in a long-term trend or an upwards trend is just to use, well, use your eyes for one. This is a daily chart. If I see I have a series of higher lows over a few weeks, then I can probably tell myself, yeah, we're probably in an uptrend. All right. So your bias during the day when you're trading is to take long trades. Conversely, if you notice that you are going down over a period of days, then you would probably begin to realize, well, I'm probably in a short trend, and you would have a short bias for a while. Okay? Trends last for a while. Well, I mean, relative to their time cycle. So, or relative to their, what kind of chart. Daily charts, trends last a while, obviously on a 5-minute chart, trends are not going to last for a year. They just don't work like that. The trends change frequently. All right. And additionally, when we're discussing behavioral trading, we need to look at, the issue of guessing. The human mind is likes to guess. And the only reason why we like to guess is that we don't like an incomplete picture of things that are happening. We don't like to see a picture that is not clear. When I was talking about, or if you've seen the you'll see after the psychology series, we'll see in the trading methodology and risk management, I discuss the issues of one of the big errors that traders make is that they get paralysis by analysis. All right. And so, as humans, we want to get as much confirming data as possible to make a decision. And we don't like to make a decision if there's incomplete data or if there's not enough of it. And so we run this risk of being unsure and being too analytical. And so we have to guess. We have to do our best to make a decision based on the data we have. Because if you wait for everything, it's just not going to work out. That's just how it is. The other part of behavioral trading is that we need to understand how new traders, what they are doing and how they are failing. Okay? If you're a new trader, or if you've been trading for a while or trying to become a good trader, you've probably gotten familiar with moving average crossover systems, which I hate. I think they are the devil. I abhor them. I think they are something that is sold to new traders as a great idea, and they're not. And moving average crossovers are just generally they're two moving averages. One's a fast moving average, one's a slow moving average. And we'll change this into like an 11-day. Okay. And actually, you know what? I want to make them a little thicker too. Moving average crossovers. If you're a profitable Forex trader, that means that you've been in the market long enough where you made this stupid mistake too, where you thought that crossover systems were effective. All right? Because in a moving average crossover system, it teaches us that, well, when the fast line crosses above the slow line, that's when we take a buy. That's when we buy. Okay? Or when a fast line crosses below a slow line, that's when we would take a short. So if we were just to look at the market replay here, move it back to right here maybe, we know that if we let this play out, we're looking at conditions almost being met where we would probably take a short there, right? Because it's going to cross, but it doesn't. I want you to keep watching this for a second. As we're moving, notice where the moving average appears and when the new candlestick appears. because in a current chart, actually go to a minute chart and watch this, but all right, so let's say we're waiting for a short confirmation, and we would take a short at that next candlestick. That one seems like it would work out pretty well, right? You take a short probably down here, get chopped around a bit, and funds and expert traders know about moving average crossover systems. They are great ways to annihilate the accounts of new traders and to take advantage of that kind of activity. You know, looking at this is on a daily chart. If you were to take a short or a long every time it crossed, you'd be in a world of pain. Because you got to think of it this way. The crossover doesn't happen until after the close of a candlestick. So this current daily, we wouldn't see the cross until after the close of this candlestick here, and then if we took the short because it crossed, we would be out of money. All right, look how many people participate in the crossover, and then look how often those crossovers are turned into traps. Because the behavior of a crossover system is that new traders will respond to this lagging indicator, and then they will participate in a short because, well, that's what the crossover system teaches them. But then everybody else knows that new traders what are new traders? They are excitable, they are undisciplined, they are anxious, they are afraid. And so if they're short and they think they took the right signal, and we're patient and experienced traders, we'll take the counter move. We can trade against the behavior of new traders and watch them fuel the rise to the top and back and forth. It's a very, very, it seems kind of mean, but that's just how the markets are. I mean, the markets are always going to move in the direction that is going to cause the most amount of pain to the most amount of people. All right? And we have to really get into the mindset of identifying where these zones are, because we have to be aware of market structure and indicators, but we also have to be aware of, well, what would a new person do? Use another example. Let's go to an hourly chart. We'll hide these moving averages, and we'll look at excuse me. You know what? Actually, let's do a 30-minute chart. And, well, sorry, I'm going all over the place. Let's look at a daily chart, and then let's just look at some past price action. Let's say we're just going to draw some pretty dynamic, support and resistance zones. Like, all right, it looks like I've got 3 bottoms here, so I'll just draw. There's a support zone here, and it looks like there's a resistance zone here. Now we can change the colors to make it look, cool. So I've got these areas here in our price action. All right. Then what I want to do is I want to take a look at shorter time frame. Go zoom back to where we are. There's our lines. And then we can see maybe the hourly. Maybe the hourly is a little better. Okay, so we can see these support and resistance zones, okay? Now, one thing that new traders learn a lot is about pivot points and these kind of subjective areas of support and resistance. And so we know that when new traders go into a market, they will often buy the tops and sell the bottoms. Okay? Example of this, because what new traders learn is about breakouts. Like they learn about Keltner channels, they learn about Darvas boxes, they learn about these these areas. Keltner, I want Darvas box. Oh, you know what? They don't have a one like that. Well, that's okay. Anyways, so we have these support and resistance zones. And most of the time, if you're an experienced trader, you kind of get out of this mindset that new traders do. So as an experienced trader, we look for prices to go down to a low area for us to buy. Okay, we look for that, and we probably use an indicator like new traders would use something like the MACD. And what new traders will do is they'll look for something like a breakout, because they learn about breakouts a lot. Every new trader learns that breakouts are a great way to make money, and so they're more concerned about getting in on a short or a long at an area of resistance. They'll wait for price to get up to these zones and try to drive it below it. Instead, this is where it happens: is new traders come into this area, and you can tell, because look at what happens when we get to our first resistance zone or support zone. A lot of volume steps in. You know what that volume is? That's new people. That's new people. They're not trying to buy this up. They're trying to short it down. And it doesn't work. I mean, even by any oscillator, because the issue here is that if we're looking at the MACD, new traders assume that because the MACD is below this line and that it's sloping down, they assume that means we're going to have lower prices continuing because it's sloping down. They don't understand the mechanics of how an indicator like the MACD works, or the behavior of price when it gets down to these elevated selling zones. And so they try to sell it further. And then we see prices continue to trend and trade. And if we move forward in time, we see as we approach these tops, when we see volume spike up near a top or a bottom, we know that these are all people who are getting in too late. This is all new people. And this is maybe kind of a cruel thing to think about, but the market and the behavior of it requires money to be in it. New money needs to be in here to participate. So, when prices are low, new traders are apprehensive about getting in early. But they see things like this, these candlesticks moving up and down, or rather, they're just moving up. They start to think, oh man, I missed the move, okay? And then it's right about here is where new traders start pouring, because they get the FOMO, they get the fear of missing out, so they jump in. But in reality, we see that was not a good idea, and prices fall down. And we can see frequently throughout any chart that where we see a high or a low, and we see the volume increase at that high or low, that's telling us that traders who are new got into the move too late. All right? Where they also get burned is probably after they've noticed this activity going on, they start to wise up a little bit and think, okay, well, finally, I know to sell high and buy low, even though they probably won't do it. Then we get into this activity, because this will trick even experienced traders. Is you get a condition where we're up against this resistance area, and then we get a breakout. But what happens? They look at the oscillators. They're like, oh, on the hourly, these are all overbought. These are all overbought. This is a fake breakout. Is it a fake breakout though? No, it's not. Because we have tested in a higher value area, we pulled back, but the pullbacks keep getting shallower. And so that's the warning sign that we're coiling for a breakout above. And this becomes one of those instances where the indicators down here, these oscillators, where they don't matter anymore. Well, they still do, but I mean, just not for the time being. Once you have this big breakout out of this prolonged resistance and support range trade, once you have this breakout and a test and a hold of it, you're just gonna keep moving in the opposite direction. And new traders get caught up. Unfortunately, they will get burned multiple times before they wise up. But by the time they wise up, they get burned finally by realizing that the breakout has actually happened. So that's one thing to be aware of. You know, the herd instinct is normal. It explains why we imitate others. It's why we follow others. And when the market's moving up and down, we like to be kind of a herd. Now, herd behavior sounds like a bad term, but in the market, it can be a good or bad term. You know, we want to follow the group to some degree. And we just want to be aware of where the masses are moving, and especially where big money is moving. And if you want some hint to what big money's doing, if you want some a good behavioral kind of a look at what big players are doing, is when you look back at the past price action, like in this range, look at these volume bars. Okay? If you see the tops of the volume, if most of the areas are green, you have these big spikes in volume, that's called accumulation. Notice how high the green bars are compared to the red bars. When you see activity like this is giving you an early warning sign that something's going to change, and that's going to be to the top side, because when you have these aberrations, well, they're not really aberrations, but when you have these big spikes in buying volume, that is telling us that people are accumulating in these areas. Conversely, when you start to see red bars, bigger red bars show up, that's telling us that we're getting some early distribution before the big fallout happens. All right? It's a vicious world out there, and you know, we have to be aware of how we react, because we react the same as everybody else, and we need to be aware of the direction of the big players as well, because that's the direction we want to be going. And often the direction we're going to be going with the big players is not obvious right away, so we have to keep our eyes up for those things. Thank you for watching this video, and I look forward to talking with you in our future videos.